Asia didn't announce anything. It executed a pivot so abrupt that traders thought their terminals were malfunctioning. Every major borrower from Tokyo to Jakarta stopped touching the US dollar overnight. And before anyone could process the silence, Scott Bessent moved in the opposite direction, ordering global investors to buy more American debt as if the world hadn't just stepped away from the currency behind it. Two continents made opposite decisions in the same hour, and the gap between them is now opening into a fault line. Because when Asia cancels dollar borrowing and the US demands more buyers at the same time, the question stops being what happened and becomes who blinks first. Funding desks passed messages quickly. Borrowers had shifted so aggressively into euro markets that syndicate teams in Frankfurt said order books were filling before dawn. Euro swap spreads moved in ways that made the choice look less like diversification and more like a rejection. The dollar, usually the gravity center of global finance, felt unusually light. It takes years for a currency to earn perception as a risk. It takes only a single morning for that perception to surface. Inside New York, the Treasury's issuance schedule was already fixed, roughly $1.15 trillion over the first 2 quarters, an increase of about $150 billion from the year before. Most of it would be absorbed by short-term bills, but the unavoidable load sat on the 2-year through 10-year range, where foreign participation had historically mattered. Dealers knew the U.S. couldn't slow issuance without derailing everything the administration was attempting. Industrial policy, military commitments, and infrastructure rebuilds each demanded capital faster than tax revenue could supply it. Meanwhile, private borrowing was mounting its own competing campaign. AI infrastructure spending had shifted corporate debt markets from a steady incline to a vertical climb. What began as under $20 billion borrowing before the boom had surged toward $150 billion. And every new hyperscaler data center, every transformer upgrade, every land acquisition, every fiber expansion, pulled money into a single sector at a scale that eclipsed traditional industry. Capital, once spread across the economy, was pooling in one basin. Smaller firms watched liquidity drain away, not through crisis but through attraction. The money followed the promise of computational power. And the labor market revealed the damage. Small businesses reported shedding more than 120,000 workers in November, the heaviest cut since the shocks of 2020. Over 7 months, the losses exceeded 250,000. While mega-cap technology firms expanded hiring to support AI development, the rest of the economy tightened. Tariffs drove input costs higher, imports became more expensive, margins shrank, credit lines thinned. The divergence between the country's technological peak and its commercial base widened each week. Treasury Secretary Scott Bessent attempted to counter the narrative by highlighting year-to-date Treasury returns of around 9%. But foreign investors measured returns differently. The dollar had fallen roughly 9%, erasing their gains. At the same time, gold rose close to 60% in dollar terms, pulling global capital toward a commodity that cared nothing for policy guidance. Investors didn't argue with sentiment. They argued with math. What arrived next was not math, but imagery. The Treasury Secretary's new public-facing campaign featured Franklin the Turtle purchasing U.S. debt with serene confidence, an attempt at reassurance in a market that traditionally required none. Analysts saw the message and asked the obvious question: if confidence were high, why appeal to sentiment? The contradiction was not subtle, it announced itself. Asia didn't wait to interpret it. Euro-denominated issuance from Asian companies and governments reached 86 billion euros for the year, a 75% increase. Euro deals now represented a record 23% of foreign currency issuance in the region. Borrowers were not simply taking advantage of temporary conditions. They were transitioning toward a currency with lower swap costs and less political volatility. It was direction, not drift. The most visible example came from SoftBank. After swapping dollar liabilities into euros, the effective borrowing cost dropped by nearly 25%. That single figure moved across trading rooms faster than commentary. Every treasurer in Asia could calculate what that meant for their own books. And honestly, the more they ran the numbers, the more the euro absorbed the flows once destined for dollars. The shift repeated itself in energy markets. Despite sanctions, Russian crude continued flowing to China and India. India secured barrels at around $5 below benchmark levels, and some settlements cleared in UAE dirhams rather than dollars. The discounts, the currency flexibility, the political insulation, each reinforced the next. Supply chains didn't break, they adapted. And as they adapted, they tested the edges of the dollar network without hesitation. Ship trackers saw a sharper transformation. Volumes from sanctioned Russian producers fell from roughly 3 million barrels per day to about 1.5 million. Yet shipments from newly formed replacement exporters surged by more than 1 million. Different company names, same ports, same wells, same crude. Russia's low production costs let it remain profitable even through discounts. For India's refiners and China's industrial base, cheap energy was survival, not strategy. They took what worked. Statements released during high-level meetings between India and Russia made the alignment unmistakable. Indian leadership emphasized Russia's reliability as a long-term energy partner, calling their cooperation foundational. In a world fracturing along supply chain lines, such statements are not ceremony. They are architecture. China sent its own signal through materials rather than words. Licensing requirements tightened further on rare earth products used in motors, avionics, and advanced electronics. Compliance thresholds rose enough to limit flows toward U.S. contractors without imposing an outright ban. The leverage remained intact. The message required no translation. All of this converged as the U.S. moved deeper into a policy landscape defined by tariffs, industrial rebuilding, and rising deficits. Tariffs raised costs throughout the supply chain. Manufacturing incentives required federal funding. Military spending remained elevated. Revenue could not keep pace. Treasury markets carried the difference, and now the markets were being asked to carry more. Foreign participation in note auctions began to shift. While demand did not collapse, desks noticed thinner cushions. Bid-to-cover ratios tightened. Indirect bidder participation, often a proxy for foreign appetite, slipped in several recent auctions. Not enough to spark alarms, but enough to confirm a trend. The world was recalibrating its exposure. Yet Washington continued to push the message that global appetite remained strong. Bessent insisted that investors would continue to support U.S. issuance, pointing to stable domestic demand and improving macro indicators. But markets weigh words against flows, and the flows told another story entirely. Asia's refusal to borrow dollars meant fewer natural dollar holdings in the system. Energy buyers using alternative currencies meant fewer recycling channels back into treasuries. Borrowers choosing euro markets meant fewer synthetically hedged dollar positions. Each step pulled a thread, and each thread led back to the same source. Evening trading illuminated the pattern more clearly. Long-end United States yields widened modestly, a small move but one that signaled tension. Risk desks noted that the Treasury's reliance on short-term bills created rollover exposure that would amplify any future volatility. The yield curve was not a forecast anymore. It was a reflection. Dealers watching cross-currency basis markets noticed something subtle. The cost of swapping euros into dollars remained less attractive than swapping dollars into euros. The pricing favored issuance away from the United States currency. It was not sentiment. It was arithmetic. Across the Pacific, European bookrunners confirmed that demand for Asian euro deals remained strong. Telecommunications firms, industrial conglomerates, and state-linked entities all tapped euro markets at costs far below comparable dollar levels. They weren't experimenting, they were establishing alternatives. Meanwhile, Russia's rerouted oil exports continued unaffected. Replacement entities expanded. The discounts held. India and China sustained their intake. Every barrel bypassed the dollar. Every shipment settled through alternate channels. Every flow created precedent. And precedent has a way of becoming structure. Inside Washington, Treasury Secretary Scott Bessent tried to stabilize the message. He highlighted domestic resilience, ongoing trade negotiations, and policy momentum. But markets observed that the messaging did not match the direction of global capital. The Treasury needed buyers just as fewer foreign investors held dollars in quantities large enough to participate. The world had not rejected the United States. It had simply begun balancing it. Late into the night, a quiet change settled in financial rooms across 3 continents. Analysts recognized that Asia stepping back from dollar borrowing was not an isolated event. It was a hinge. Once a region changes its funding currency, it changes its reserve mix, its hedging habits, its portfolio exposures, its trade invoicing, and its debt structure. The decision cascades. Treasuries fed by global recycling grow weaker when the recycling slows. A dollar supported by habitual borrowing loses momentum when the habit breaks. And a financial system built on assumptions begins to test what happens without them. As screens dimmed across trading floors, the question traders whispered felt less like speculation and more like a signal forming. If Asia won't borrow dollars, and energy buyers won't pay dollars, and corporates won't hedge dollars, but the United States plans to issue more debt than ever before, what happens when the world realizes the next trillion has nowhere left to land? No one pushed back against it, and no one answered. If Asia's silence was the first shock, what comes next won't arrive quietly. A world that stops borrowing dollars doesn't stay neutral. It begins building a new center of gravity, and every step away from the United States currency widens the space America must fill alone. Washington can urge investors to keep buying, but markets don't follow orders. They follow pressure. And the pressure is moving, because the moment $1 trillion of new United States debt meets a global system that's already turning its back, the outcome won't be decided by headlines or speeches. It will be decided by who shows up, and what happens if the answer is no one. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.